morning. Let us begin. Does anyone have any question before we start? Any concern? So we have an exam coming. The exam will be on the upcoming Tuesday. And as you can see, we have been able to cover only one chapter after our exam 2, which was the chapter on monopolistic competition and game theory. And today I will finish chapter 14, and these are the only 2 chapters that will be included in exam 3. After I finish my chapter 14 today, I will upload a new quiz and a new homework on this particular chapter. I will also upload a sample exam in Blackboard, and your SL leaders will get in touch with you, and they will tell you when the review session will be taken. Although it might appear that you are only dealing with 2 chapters, I think by now you have seen that these 2 chapters are pretty extensive. And I would hope that you are going to, you have already started preparing for the upcoming exam. If you are not, this is the right time to start preparing. So today we are going to basically finish the remainder of this GDP chapter. Again, I'm going back and forth between different supplemental materials, so please keep track of where we are covering the materials. So this is what we have covered so far. We have defined what GDP is, what is included in the GDP, what is not included in the GDP. I have shown 2 ways we can calculate GDP. One was the so-called production approach, and the other one was so-called the expenditure approach. In the production approach, we calculated the value addition made by every firm in every stage of the production, add them together, that was our GDP. In the expenditure approach, we identified the expenditure of every player in the economy, the consumer, the firm, the government, and the rest of the world. We identified the expenditure of the household, expenditure of the firm, expenditure of the government, expenditure of the rest of the world, added together, they were equal to the GDP of the economy. At the basis of all this calculation was the assumption that in any economy, the expenditure made by the economy is equal to the production made by the economy, is equal to the GDP of the economy. Today, we are going to look at the final method of calculating GDP, and this is by far the most challenging one. The approach that we are going to introduce today is called the income approach. And the idea behind the income approach is a very straightforward one. Similar to the expenditure approach, where we calculated the expenditure of every player in the economy, we will try to calculate the income of every player in the economy, add those income together, and we will find something called income, and we will somehow back out our GDP calculation from that income. That income, which includes every income of the economy, is going to be called the national income. And national income will be just the starting point of how we can go from the income of the economy to the GDP of the economy. Let's look at so this particular method follows a whole list of concepts that we need to understand, memorize, and be able to apply. At any point of time today, if you have any question, please let me know. The first definition that we are going to cover is called national income, which is the total income earned by the factors of production owned by a country's citizens. I already introduced this idea in the previous class, where national income is interested in figuring out the income of the citizen of a country, regardless of where they live. You could be an American citizen living in Germany, and the income that you generate in Germany is part of this national income. Now, our objective is not to understand about national income and national income. Our objective is to figure out how we can calculate GDP. But the process of going from national income to GDP goes through several stages of calculation. Bearing that in mind, we will start the process of calculating national income. So national income is the income of everyone in the nation. And those everyone could be government, could be households, could be firms. So therefore, to understand the income of everyone in the economy, we are going to look at the various sources of income in an economy. Some of these sources of income accrue to the household, some of them are income for the firms, and some of them are income of the government. Perhaps the most important source of income in any macroeconomy is this idea of compensation of employees. Compensation of employees include salaries, wages, the various supplements like employer contribution to social insurance, like your social security card payment, your 401 contribution, pension funds. It can also be include. It can also include the transfer payments that individuals receive from the government. So, what is a transfer payment? So, discussion is not in the slide. A transfer payment refers to the payments for which the government, does not get anything out of it. So, transfer payments. Transfer payments are basically free money. Can anyone give me an example of free money? These are money that is given to you, to household, let's call it HH. Can anyone give me an example of a transfer payment? Free money that you receive from the government. The first and probably the most prominent example of transfer payments is food stamp, where if you qualify for the food stamp, every month you are going to get some lump sum payment from the government. And the government gives you that for free because there are some social obligation by the government or for the policymakers. Unemployment benefit is a transfer payment. When you do not work, meaning that government is not getting anything from you, you still get payment so that you can live by. Medicaid, if you qualify for it, is a transfer payment. Now notice that these transfer payments are not earned on the basis of your work, but they do add to your income. Do we all see that? So they are called compensation of employees. Some of these compensations are paid by the firm, some of these compensations are paid by the government, but they are income of the household. The next one is called proprietor's income. Proprietor is a formal word for self-employed person. So if you are a farmer, if you own a restaurant, the income that you generate is called proprietor's income. And the reason why you separate proprietor's income from compensation of employees is because they are treated differently in tax policy. If you are a farmer or a self-employed person or own a business, you pay less tax than a person who earns a W-2. Somebody who earns a wage pays more than somebody who is self-employed. So proprietor's income is clearly an income of a household which has tax benefits. The next one is rental income. This is income received by property owners in the form of rent. Now, a household can be a property owner. If you have a house, you can rent that out to anyone. Or if you are a corporation that owns a property, an apartment complex, the rental income that you generate could be the income of a firm. So unlike the previous two, rental income could be the income of a household or it could be the income of a firm. We are not going to distinguish between those two. We simply need to understand it. The next one is called corporate profit. This is the income of the corporations. So the income of the corporations are mainly the profit level the firm reports every year. They pay a hefty amount of tax on that, and corporate profit is indeed the income of the firm. net interest is something of interest to a lot of people. So net interest is the interest paid by business. So firms regularly pay out interest on their borrowing. And net interest is basically that interest rate being paid, that interest being paid by businesses. Firms sometimes pay that interest to other firms. Firms also can pay that interest to households. If a firm borrows that money from a bank, the interest rate that firm pays is a payment from one firm to another firm, because the bank is also a firm. Do we all agree? Make sense? How can firms pay interest to individual households? Anyone? How can firms, or how can you as a household receive interest payments from firms? Anyone give me some examples where firms pay interest rate to households? So if you buy a stock from a stock market, that basically is a piece of ownership of a firm, and every year the firm will probably pay you some kind of dividends, and that is basically an interest payment by a firm to you. Are we all clear? If you buy a bond, the nature of the bond is that whenever a firm issues a bond to borrow money from the household, the firm will be paying an interest rate on a regular basis, monthly, yearly, 6 month, and at the end of the maturity of the bond, you are going to get a face value. So these are all examples of net interest paid, interest paid by businesses to households. Also, please remember that firms can also buy stocks issued by other firms. The next one is also fascinating. This is basically indirect tax minus subsidies. Indirect taxes are examples. Examples of indirect taxes are like sales tax, customs duties, and license fees. Indirect taxes are different from direct taxes. The most common direct tax is your income tax. Can anyone tell me what does the government do with your tax? Does anyone know? What does the government do with the social security tax that you pay? Anyone? What does the government do with the social security tax that you pay to the government? The government puts that tax in an account called social security, and when you retire, you actually get that money back. So the direct taxes that you pay to the government will have a lot of restrictions not to be able to use it. So direct taxes are not really income of the government, contrary to what a lot of people believe. However, the indirect taxes, the sales tax, the customs duty, fees, and all these things, government can take those and use whatever they like, in whichever way they like. Sometimes they use that for budget formulation, sometimes they can simply keep that money in their treasury. So one can argue that the indirect taxes are basically income of the government. But then, government also has some expenditures. We already have talked about some of the expenditures that the government carry out when they pay transfer payments to households. We are not really interested in the transfer payments because transfer payments is part of the income of the household. We are interested in another form of government expenditure called subsidy. Subsidy are free money given to firms. Just like transfer payments, which the household receives as free, firms also receive free money. They are called subsidy. When you look at this particular expression, indirect taxes minus subsidy, you are basically seeing an attempt to characterize the income of the government. because whatever tax the government receives minus the subsidy that the government gives out to the firms is indeed the income of the government. Subsidies are very similar to transfer payments. Subsidies are paid to firms without any expectation, so they are free money just like transfer payments, like Medicaid or unemployment. The next one is kind of fascinating too. It's called net business transfer payments. Net business transfer payments are transfer payment made by businesses to others. So remember, transfer payment was free money given to households. Sometimes free money can also be given to firms. We are going to now talk about that. Do firms carry out transfer payments? We know government does. Government pays unemployment benefits, food stamps. Can anyone give me an example of transfer payments carried out by firms? I am starting to worry about you guys. You have an exam on Tuesday, so we need to engage a little bit more. I need some feedback from you guys. These are the questions that I'm trying to raise and basically trying to raise in the class is because I want you to be able to understand the broader picture in this chapter. Right? The question is a rather simple one. So, do firms give out free money? They do. They provide charity. Warren Buffett just announced half of his wealth to be given to charity. Microsoft regularly gives out free, laptops and computer equipment to children in need in many developing countries. So these are all examples of free money paid out by firms. So they are basically net transfer payments. Those payments can be made to individuals. Those payments could be made to firms as well. But they are transfer payments made by firm to households or individuals. Individual firms. They are different from the government. Make sense? Okay. Does anyone have any question? The next one is called surplus of government enterprise. Now, when I talk about this particular term, it always creates confusion to American students because in USA we see very few examples of government enterprise. Government enterprise is basically government-owned firms. These are firms, like they have a profit maximizing objective, they have budget, they have operations, but they are owned by the government. They have an ownership that is the government itself. So, can anyone give me an example of government enterprise or public enterprise in USA? Sorry? Law firms? Which law firms? So you're talking about, if you are talking about the Department of Justice, that is part of the government, true, but they don't really provide services, so they are not a firm. Well, that's usually the most common example that people give when they talk about U.S. Government enterprises, and you are partially correct. Till the 1980s, the ownership of USPS used to belong to the U.S. government, but over the last 20-30 years, that ownership has sort of evolved a lot. So USPS is no longer owned by the government. So it's not a government enterprise anymore. Back in the 1960s, AT&T used to provide analog telephone services for the entire economy. The government is to own or is to employ AT&T to provide that service. So the ownership of that service did not belong to the government. Are we all clear on that? So AT&T in the 1960s was not a government enterprise, but they were providing services in close collaboration with the government. But the city of Fayetteville Utility Service is an example of a government enterprise. They provide you with the service. They are owned by the government, right? You pay a price for the service. So everything is operating like a farm. The only exception is that it is owned by a government, and therefore it's a government enterprise. In other countries, government enterprises are plenty. The National Bank of China is an example of a government enterprise. It's a bank owned by the government. A bank is a firm. They make profit, they provide services, they charge for the services they provide, they do everything like a firm. In Saudi Arabia, where I used to teach for 4 years, the second largest cell phone carrier is a government-owned organization. So government owns the second largest cell phone carrier in Saudi Arabia. That's an example of a government enterprise. If the government, these enterprises earn some kind of surplus, which is basically their revenue minus their expenditure, notice that we are using a very different word. We are not calling it profit. Have you noticed that? We are calling it surplus. Surplus is total revenue minus total cost. Why is it a surplus? Why is it not a profit? Why do we call the surplus, which is the difference between total revenue minus total cost by a government agency, surplus and not profit? Any thought on this? The answer is it's all political. Most of the times, government enterprises are not supposed to be profit maximizing, but rather than providing services to the economy. So government does not use the term profit, but uses the term surplus. It doesn't really make any difference. It is the income of the government. If you can identify the source of each of these income, the methodology is very simple. You identify all this income, you add them together, and the resulting number will be called the national income of the economy. In 2012, the national income of the economy was this really humongous number, 13,833 billion US dollar, which is a very large number. And notice something fascinating about the surplus of government enterprises in USA in 2013. That's a negative number, which means that some of these companies were basically earning loss, right? Their revenue was smaller than their total cost of production, and it kind of makes sense. Most of the government institutions and enterprises are clearly inefficient. So that basically is a way to calculate national income. The idea is that you identify various sources of income, you add them together, and that should give you a figure called national income. But we are not interested in national income. What we are interested in is GDP. So the next table is the process that we are going to use to go from national income to GDP. The process is complicated. I'm going to cover this twice, just to explain each steps. And if you have any question, please stop me and ask questions. So our objective is to go from national income to GDP calculation. We want to understand the relationship between the national income of the economy and the GDP of the economy, because they are not the same thing. The table basically shows you how, given information about GDP and some other information, how you can go from GDP to national income. We are going to reverse that process. We are going to show you the process that will allow you to go from national income to GDP calculation, because that is the kind of question you are going to encounter in the exam. So what we are going to do is that in order to go from national income to GDP, in order to calculate GDP from national income, we are going to do a reverse of this table. Which means that if I have national income, I am going to add statistical discrepancy to get net national product. I am going to add depreciation to get GNP, something that I discussed before, and I'm going to do it again. I am going to add payments of factors of income to the rest of the world, and I am going to subtract receipts of factor of income from the rest of the world, and it will give me the GDP number. The process looks tedious, and you have to, in some way, memorize the process. But let's now talk about the resulting number and why and how we get that. Let's do it one more time. In order to calculate GDP by using the income approach, we are going to reverse engineer table 6.4. We are going to start from the bottom of the table and we are going to slowly go up. We are going to do that by basically reversing the sign that is mentioned in the table. If we have national income data, we are going to add a statistical discrepancy to that number. What is statistical discrepancy? Statistical discrepancy is a summary of the kind of mistakes that economists have made when they were trying to collect data on GDP. And those mistakes could be substantial. Some of those mistakes could be finding the wrong data. Some of these mistakes could come from the fact that when you are inputting the data in a spreadsheet, you just entered wrong numbers. You have to understand that the process of calculating GDP goes through a very large workforce. A labor force over and above 15,000 is basically interested in calculating a singular number. Obviously, there are going to be a lot of mistakes. Rather than identify each of these mistakes, the economists basically come up with a number, a single magical number that is supposed to account for all the statistical mistakes that we are making in the calculation. So statistical discrepancy is basically an estimation of the errors made in the calculation. If you add the statistical discrepancy, you are going to get something called net national product. The next one is called depreciation. Depreciation is a fairly common term, and most of us have a good idea about what depreciation is. I want to understand depreciation from a macro perspective. As you all know, depreciation refers to the wear and tear of your assets. Wear and tear of your assets. What is the empirical significance of depreciation? Why is depreciation important in a macroeconomy? There are two reasons. Number one, depreciation leads to a reduction in the value of your assets. What does that mean? It means that if you buy a $35,000 car, a brand new car, the moment that you take the car out of the showroom, the car loses 10% of its value. Did we all know that? Depending on the model of your car and the year of your car, the depreciation of a brand new car could be as high as 25%. And I'm not making this up. I actually know which car has an immediate 25% discount in the depreciation value. Can anyone guess? Can anyone guess? Which car loses 25% of its value immediately getting out of the showroom, even if you are not driving a single mile? Mitsubishi. A brand that you are not that familiar with. I think the only Mitsubishi car that you are familiar with is a Mitsubishi GT. There is a sports car sedan version of Mitsubishi. Mitsubishi is a pretty big company. You know, they produce a lot of goods, but their car has a very high depreciation rate, which is kind of sad. Okay, is that the only reason why we worry about depreciation? Depreciation, leads to a reduction in the value of our asset. Depreciation also has other important macroeconomic implications. Depreciation is a cost to you, right? If your car depreciates, you take your car to a mechanic, have the mechanic fix your car, have some kind of oil change or whatever you want to do. So depreciation is a cost to you and income to someone else, right? Because along the way, this depreciation generates income for a wide variety of different people in the economy. So by including depreciation, we are still within the vicinity of defining income of various players in the economy. So that's depreciation. Once you add depreciation, you find something called gross national product or GNP. Our discussion now starts becoming more complicated. So GNP, as I mentioned before, is gross national product, the total amount of output the citizens of the economy produce. Citizens of the country produce is called GNP. For a long time, this GNP number was very popular. Economists used to regularly refer to GNP as a possible way of talking about the macroeconomy. Over time, it became obvious that GNP is not a good measurement of how well the country is doing. Because GNP suffers from two fundamental problems. One is that it includes income earned by an American citizen living in Germany. And that doesn't make any sense. If you're an American citizen who owns an ice cream parlor in Germany, the income that you generate is part of the national income. The income that you generate is part of GNP, but you are not contributing anything to the economy. You are not producing anything. Do you all see that? So that's one part of the problem. The second part of the problem, which led to the decline of GNP as the predominant measure of output, is that when you are calculating GNP, you ignore the production contributed by non-citizens in the economy. And there can be a lot of those. In some of the Middle Eastern countries, as I mentioned in the previous class, the non-citizen population contributing to the labor force could be as high as 80%. So GNP is not very strong. You have GNP number and then you have to somehow make adjustment to that number to get your GDP number. So let's do sort of like a hypothetical comparison before we move on to the calculation, because the calculation will be in your upcoming exam. So we have GNP. So in the GNP, I have income of American citizens living abroad, and I don't have income of non-citizens living in USA. And I have GDP. I want GDP to include all the value of goods and services produced within the boundary of that country. Since boundary is important for GDP, I need to remove the American citizens living abroad from my GNP number. Make sense? And I also need to add the income of the non-citizens in the GNP calculation to make it GDP, because boundary matters for our GDP. In GDP calculation, regardless of whether you are a citizen or a non-citizen, as long as you are inside the country and you are producing something, you are contributing to the GDP. So, the process of going from GNP to GDP is as follows. We are going to first add payments of factor income to the rest of the world. So this is basically paying to the non-citizens. And we are going to subtract receipts of factor income from the rest of the world. This is income of American citizens generating abroad, because they are not relevant for our GDP calculation. And that concludes our discussion about how you go from national income to GDP. As you can see that the process is complicated. You need to memorize the entire process. You are going to surely have one, or if, and in some case, I haven't decided yet, probably more than one question from this concept. So therefore, let's do one more time. Well, let's do this one more time. To start with national income, that's the income of everyone in the economy. You add a statistical discrepancy, you add depreciation, you add payments of factors of income to the rest of the world, and then subtract receipts of income from the rest of the world, and you find GDP. Out of this entire table, this is the most important relationship that basically stands out, and in order to show the importance of this, you are going to have a separate question for this kind of question. So if you somehow have GNP, the process of going from GNP to GDP is that you add income of non-citizens living in USA and you subtract income of citizens living outside USA. How does this process work? Let's look at an example. Let's say I give you a table like this. I give you a table like this where I include a lot of information that you can use to calculate income, national income by the income approach, and then go from national income to GDP. In order to fool you, I will add some additional information that you do not need in the income approach. First, let's take a moment to look at all the data that is available, figure out which data is irrelevant for our income calculation, and then proceed. I would like somebody to point out which particular data will not be used in our income approach. Anyone? Yes. They will be useful because you need to go from GNP to GDP. You are right that you don't need that for the national income calculation, but you will eventually need it for the GDP calculation, which we are going to show. But there is one data that is completely irrelevant in our entire income approach calculation of GDP. Yes, please. Very good. Very good. Direct taxes are not discussed in the income approach. And please remember, I will ask you a question related to this table, and I always do that to my undergraduate students, and people always make mistakes because they add the direct tax. Don't do that. Other than the direct tax information, every other information is going to be useful in going from national income to GDP. Let's see how this is done. The first step is obviously to calculate national income, which is basically equal to the sum of compensation of employees, proprietor's income, rental income, corporate profit, net interest, indirect taxes minus subsidies. So please remember, this is basically the income of the government, net business transfer payments, and the surplus of the government enterprises. Unfortunately, in the table, there was no information given to net business transfer payments and government surplus of government enterprise. Do we see these two information? Do we see any information about net business transfer payments or the surplus of government enterprise? The answer is no. Since you do not have data on certain variables, you are going to assume them to be equal to 0. Do we all see that? You add the rest of the numbers and you get this number 635, and that is your national income. Well, calculating national income is not sufficient. We now have to go towards calculating the GDP. After we calculate national income, we are going to first calculate net national product, which is national income plus statistical discrepancy. Notice that there is no information about statistical discrepancy, so it is also equal to 0. Then we are going to add depreciation to net national product in the table, just like in the table, and we are going to get our GNP. After we get our GNP, I am going to add payment of factors of production to the rest of the world. So this is American, this is payment to non-citizens living in USA. And I am going to subtract the receipts of factors of production from the rest of the world. So this is the income of American citizens living abroad, and I will find my GDP number, which is 710. Any question? While we were doing this calculation, we noticed that there is a significant difference between GNP and GDP. GDP is not interested in distinguishing between citizens and non-citizens, and GNP, is interested in only focusing on the citizens of an economy. When you do that, in the GNP calculation, you only focus on income generated by the citizens, regardless of where they live. So the distinction between GNP and GDP is important by itself, and you will be asked questions like the one that we are about to look at right now. So if I give you a question like this one, so question number 5 or a question similar to 5 will be in an upcoming exam. So let's look at this question. What do you think the correct answer is? Anyone? Yes. Okay, so KFC is an American-owned organization. So KFC is an American-owned factors of production. KFC is located in Japan. So if KFC produces something in Japan, it contributes to Japan's GDP without any question, right? Are we all clear? But part of the income that KFC generates in Japan is basically taken back to USA and it becomes part of US's GNP because it's the income from abroad by an American citizen. Are we all clear? Are we all clear on that? So this income generated by KFC in Japan is part of US's GNP and Japan's GDP. The answer is C. Very good. That concludes our discussion about the various ways we can calculate GDP. We are now going to start the next part of this chapter, and the next part of the chapter is going to be motivated by a simple question. Why are we calculating GDP? Why? Why does the government employ such a large labor force to basically come up with a singular number? What do we do with this GDP number? The answer is we do a lot of things. Economists argue that there are these 3 important things that we can do with our GDP number. We're going to cover all these, don't worry. I'm going back and forth between different materials and I apologize for that. Economists would argue that there are 3 things we can use this data for, right? One thing is that, I guess I don't need the discussions. One thing is that I can use this GDP number to figure out how the economy is doing, right? So GDP is a measurement of production. There is an argument that if the country produces more, the income of the economy goes up, so everybody is doing better. So everybody is better off. Later on, towards the end of this chapter, we're going to criticize that view. But for the time being, GDP is constantly used to compare your standard of living or economic well-being across time between countries and to assess your current position. 3 things, right? You try to figure out how you were doing in the past compared to how you are doing today, and that gives you an idea about where you want to go in the future. You use GDP number to compare across countries because GDP is a very common measurement carried out by everyone. Now, in our current discussion, we are going to focus on this particular idea that we use GDP numbers to compare our standard of living across time. Let's say I would like to compare the GDP of USA in 1962 and compare that with GDP of USA in 2019. How will I be able to compare those? Are those comparisons going to be relevant? And what are the problems associated with this comparison? Let's start by pointing out that there are a lot of goods whose prices have dramatically changed over time. In 1962, a Chevy sedan used to cost about $4,000. Now, the similar kind of Chevy sedan with very similar features cost about $35,000. Do you think that a Chevy sedan in 1962 was cheaper than a Chevy sedan in 2019? You don't have to answer that question because we haven't covered the material to answer that question. If you do the calculation right now of the GDP of USA in 1962 and the GDP of USA in 2019, you are going to find that in 2019, the US GDP is at least 4 times even more than the size of the US GDP in 1962. Part of the reason why these numbers fluctuate, this number on GDP fluctuate is because prices change. Prices change. We just give an example of a Chevy. Now let's give another example that is probably more common to you. In 2007, I bought a laptop for my graduate research. I think it was a Pentium 4 or something like that, for about $1,200. The kind of machine power that my laptop had with $1,200 in 2007, I can get equally, if not a better laptop in 2019 for $365. So prices of a lot of goods fluctuate over time. Sometimes they increase, sometimes they go down. When prices change, GDP changes because GDP is calculated by using current market price. That's the definition of GDP. Now, given the fact that we are calculating the GDP in the 3 alternative approaches that I just carried out based on current market price, how useful is this number when we are comparing them across time? Because across time, not only GDP changes, but also prices change. And we are not interested in the price change. We are interested in understanding the changes in the production. How much the economy is producing today versus in the past, how much the economy can produce tomorrow compared to current situations. These are the reasons why GDP is calculated. In order for us to be able to do a more accurate comparison of an economy in the past versus current or in the future, economists will calculate a different set of GDP numbers. The idea behind this new set of numbers is very simple. Let's go back to the 1962 versus 2019 GDP comparison. We want to compare the US GDP in 1962 versus 2019. How do we do that? These two numbers are measured by using current market price. So 1962 GDP is measured by 1962 market price. 2019 GDP is calculated by using 2019 price. They are not comparable. Do we all see that? Because the price of a Chevy just increased by tenfold between 1962 and 2019. So what can we do? Economists suggested a very unique idea. They argued that rather than comparing these two GDP numbers using their current market price, why not use a common year price to calculate both of them? So rather than calculating 1962 GDP in 1962 price and calculating 2019 GDP in 2019 price, why not calculate both of these GDP by using a common price? Usually the earlier years. So if I take the price of 1962, use that to calculate the GDP of 1962 and 2019, please notice that it is now comparable. Because between these two numbers that I just calculated, 1962 GDP in 1962 price and 2019 GDP in 1962 prices, the only difference between these two numbers are the level of production. You see that? Because I have simply eliminated the price effect on these GDP numbers. This process of using or calculating GDP of various years by using this common year is called a GDP, real GDP. And that common year is called a base year. A base year is a way to commonize the market prices and use that to calculate GDP for various years. Real GDP is going to be calculated by using this so-called base year. And now we are going to look at a multiple examples of this because it is going to be an exam. The first example that I am going to look at is from your chapter corporate slides, and I will go through this table very, very slowly. If you have any question, please ask me. Let's start from the top of this table. This table provides you with information about an economy, an artificial economy in 2 years, 2009 and 2013. We are assuming that the economy consists of these 3 goods, C, I, and G. In 2009, the quantity of those goods are 10, 3, and 1. The prices are 5, 10, and 20. Given the price and the quantity of these 3 goods, we can simply multiply the price and quantity, get expenditure on each of these goods, and add them together. When we do that, we are going to get the GDP of 2009, which is 100. Do we all see that? It's a simple process. So we are basically using the expenditure approach in calculating GDP. We also have information about another year, 2013. We have the quantity and the price of these goods in 2013. We can simply multiply the price and quantity. 4 times 5 is 20, 2 times 20 is 440, 6 times 40 is 240. These are the various expenditures. We add them together, we get the GDP of 2013, which is 300. So the first 2 tables are pretty straightforward. Are we all clear? Now, the GDP of 2009 and the GDP of 2013 are not comparable. It appears that the GDP has basically quadrupled, right? Quadrupled, no? Tripled, right? Not quadrupled, tripled. From 100 to 400. 300, right? They are not comparable because these 2 GDP were calculated by using 2 different market price, 2 different years market price. So let's now do something to eliminate that price effect. Let's now calculate the real GDP, the GDP of 2013 by using the 2013 quantity, but by using the 2009 price, because 2009 is our base year price. Between B and C, we are using the same quantity but using different prices. In the last part of the table, we are using the price of the base year, which is 2009. I will multiply the price and quantity, get each of these expenditures, I will add them together, and I am going to get a number 160. So 160 is basically the GDP of 2013 calculated by using the 2009 price. And therefore, 160 is the real GDP of 2013. Another important thing to notice is that the real GDP of 2009 is the same as the nominal GDP of 2009, which is 100. Why? Because when we are using the base year price of 2009 as the basis for all the calculation, the nominal GDP of 2009 and the real GDP of 2009 are the same. Do we all see that? After we make this real GDP calculation, we notice that between 100 and 160, which is the real GDP of 2009 and real GDP of 2013, these numbers are now comparable. Because these two numbers share the same price variation. Since we calculated 100 and 160 by using the same price of 2009, these numbers are more accurately comparable, and this is the main reason why we calculate GDP. Take a moment to look at the process of how we went through the calculation of nominal and real GDP. We're going to do two more problems. The next problem is from the other supplemental material. This is a simple example, but I think equally intuitive. In this particular example, you have three goods in the economy, good A, B, and C. You have information about 2 years, year 1 and year 2. You have information about price of these 2 years. You have information about the quantity of 2 years. In column 5, you are going to use P1 times Q1, which is basically taking year 1's price, multiplying that with year 1's quantity, and the number that you get, $12.10, is the nominal GDP of year 1. Do you all agree? It's a straightforward calculation. In column 8, you are going to take P2 times Q2, which is basically taking year 2's price, multiply that with year 2's quantity, and you are going to end up with nominal GDP of year 2. Do you all agree? Straightforward calculation, right? Now, in column 6, this is the most important column. What we are going to do is that we are going to calculate the GDP in year 2 in year 1's prices. So we are going to take the year 2 quantity but use year 1's prices as the calculation mechanism. So I am going to use year 2's quantity 11, multiply that with year 1's price. So 11 times 0.5 is going to give me 5.5. Do we all see that? Then I'm going to use year 2's quantity, multiply that with year 1's price. 4 times 0.3 is going to give me 1.2. I'm going to use year 2's quantity on C, multiply that by the year 1's price of 70 cents. I'm going to have 8.4. When I add those together, I will get 15.10. When I try to calculate 15.10, I used year 2's quantity and year 1's price. So column 6 gives us the real GDP of year 2 in year 1's prices. So this is real GDP of year 2 in year 1's price. The column 5 is real GDP of year 1 in year 1's price. How do we know that? Because for the base year, which is year 1, the nominal GDP and the real GDP are the same. After we calculate the real GDP of year 1 and year 2 in column 5 and column 6, we can then compare them. And when we compare them, we notice that real GDP has gone up a little bit from $12.10 to about 15.10. We all see that. There has been about a $3 increase in real GDP. Notice the accuracy of this comparison is way better than if you compare 6 with 8. In 8, nominal GDP was 19.2, and in 5, nominal GDP was 12.10. It appears that from year 1 to year 2, nominal GDP took a large jump. You all see that. And that's inaccurate. Because the reason why GDP jumped so much between year 1 and year 2, we are comparing between 5 and 8 is because of the changes in price. And changes in price should not be included in the GDP comparison. GDP is about productive capacity of the economy. Our GDP comparison should solely focus on how well the economy is doing today compared to the past. How well the economy is doing compared to the rest of the countries. So real GDP is much more accurate in those comparisons. The next example is from the in-class problem set. A very similar kind of problem. You have information on 3 different years, year 1, year 2, and year 3. You have information about the production. You have information on price. You are assuming that there are 2 goods in the economy. So the first of the process is that it is easy to calculate the nominal GDPs. You just take the market price, the current market price, multiply it with the current quantity. So for year 1, you are going to multiply production 60 with price, which is $1, plus production 100 times 80 cents, and it is going to give you 140. We all see how this number is calculated. You can do the same thing for year 2 and year 3, and it's a very straightforward process. Okay, now the objective is to calculate real GDP. If we assume year 2 as the base year, year 1 as the base year, I am going to calculate the real GDP. I am going to calculate the real GDP as follows. In the real GDP of year 1 is also equal to the nominal GDP of year 1 because year 1 is the base year. Our task is to calculate real GDP of year 2 and real GDP of year 3. In order to calculate real GDP of year 2, what we are going to do is that we are going to take the year 2 quantities, which is 80 and 110. You guys see that? And I am going to use the year 1 prices, $1.80. So 100 times $1 and 130 times 0.8, sorry. 180 times $1 plus 110 times 80 cents will give us a number 168, and that is my real GDP using year 1 as the base year price. So we carry out this kind of calculations quite extensively. This is the first application of real GDP, is that real GDP will be calculated by using a common market price, a base year market price, and we can use real GDP to talk about a lot of things. Another application of real GDP is the calculation of GDP deflator, which I will simply define and not talk about the implication. A GDP deflator, please write this down. A GDP deflator is found by calculating nominal GDP. Divide that by the real GDP and multiply it by 100. And in 2 chapters from now, after the exam, we are going to argue that this actually is a measurement of overall macroeconomic price, an idea that we really care about. So these are the 2 of the important implications of real GDP, and we need to understand both of them. And that basically takes us to the last part of this chapter, which I'm going to again talk about by coming back to our own slides. I have basically talked, skip this discussion about real GDP and potential GDP. When we talk about unemployment after our exam, I'm going to come back to this. Our class today will end by providing a realistic criticism about this GDP number. We have already argued that there has been a substantial amount of resources spent by the economy to calculate this singular number. This number is calculated by every country in the world. Does real GDP or nominal GDP serve its purpose? Can it really tell us about how well off we are? Can it really say something about our standard of living, whether it has gone up or gone down? The answer is no. Unfortunately, no. And in that discussion, we are going to talk about the 4 major limitations of our GDP number. 4. Each of them are important. Number 1, our GDP calculation does not include household production. Household production refers to a production that takes place inside the house, like you caring for your child, you providing daycare facility for your child, you making a pizza at home. These are examples of home production. If you provide daycare to your child, the service that you provide is not included in the GDP. But if you send your child to a daycare, the money that you spend on your child's daycare is part of the GDP calculation. If you make a pizza at home, the value of that pizza is not part of the GDP calculation. If you eat the same pizza outside in a restaurant, that is part of expenditure and hence part of the GDP calculation. If you work in your father's garage and help him to fix something, that's home production, it is not part of the GDP calculation. But if you work in someone else's garage and do the same work, it is part of the GDP calculation. Why? Why shouldn't we include home production in the GDP calculation? The answer is very simple. They don't actually have a market value. They were not market activities. Are we all clear? So GDP, by ignoring household production, ignores a major chunk of economic activities. Many developed countries, including France, Finland, Sweden, now uses an approximation or measurement of home production in their GDP calculation. USA does not do it. Number 1 problem. Number 2 problem was thoroughly discussed in a previous class where we talked about underground economy. Underground economy is not only economy where drugs are being sold. If you don't have a government license and you are selling burgers, that's also part of the underground economy. Any underground economy is not part of the GDP calculation. How important is the underground economy? Well, the advisor of my master's thesis, who was the finance minister of my country in 1996, estimated that the size of the underground economy of Bangladesh in 1992 was 7 times the size of the formal economy. 7 times. Recent World Bank estimates suggest that the size of the underground economy in some of the other countries like Pakistan, Afghanistan, Zimbabwe, many of the African countries are often 23, 24 times the size of the formal economy. So the size of the underground economy is pretty big. Please remember that when we ignore underground economy, we are not only ignoring all this drug trafficking, all these illegal activities, but also legitimate business transactions. They just simply don't have government authorization. Do we all remember that? So another major problem, leisure time. So leisure time means the time that you enjoy not working. Is that important to your standard of living? Do you really care about how much non-working time you enjoy? The answer is clearly yes. Notice that GDP is calculating all the productive activities, all the production activities, and claiming that this number represents our standard of living. But it does not include the value of leisure, right? If you are working like a slave for 18 hours every day for the rest of your life, are you really better off? Makes sense. Am I clear on my argument? The final one is quite obvious. It does not include any measurement of environmental quality. The life the world that you live in is equally important in your standard of living. I usually motivate this question by asking you a simple question. Do you want to live in Shanghai? Well, Shanghai is an exciting city, right? They just opened up Disney World there. One of the most expensive cities in the world. The average annual income of Shanghai is remarkably high, considering that China is basically a middle-income country. But Shanghai also has one of the highest pollution rate in the world. People can hardly see the sun in a given day. So even if you have a very high income in a city like Shanghai, are you really better off? Do you really have a higher standard of living? Notice that your GDP number cannot answer this question because China has a very large GDP number but a very low quality of living. That concludes our discussion. Does anyone have any question? So, I'm going to upload the next quiz and the next homework. It will be due, let's say, on Sunday. And I'm going to be uploading a sample quiz, a sample exam. Your SI leaders are going to get in touch with you as to when they would like to have that review session. Any question? Good luck. We are going to have the exam on Tuesday. Please try to come to the class on time or before time.
Your butt cheeks. What? For real? That's why I pull mine down.